Hello. Welcome to our chapter on banking and bank accounts. All right, one of the first things that we need to understand when we talk about banking is their importance. Banks are necessary for our economy to be fluid, meaning that if there isn't a banking system to move money from those people who save to those people who invest, the economy will not grow. All right, so again, the terms that I just used. A saver. Most of us are savers. We learn at an early age, put your extra money in the bank. We put it in a bank because we're going to spend it at some point in time in the future. But currently, we're not spending. On the other side, there are investors, those people who need money to purchase items at this period of time. Someone might want a house. Someone might want a car. A business might want to purchase new assets. So the bank acts as an intermediary to shuffle the money from those who save to those who invest. So again, when you're looking at this, a good banking system helps the economy grow. If there wasn't a banking system, the economies do not grow. When you look at countries around the world, not all have a trusted banking system. In the United States, our banking system is trusted to the extent because our savings are insured. After the Great Depression hit, one of the acts of Congress came later in the 1930s was the FDIC. It insured the bank accounts. So your deposits, even if the bank were to go under, all right, would still be there for you. So again, that leads to trust, and again, it helps the overall economy. So again, repeating, why do we need this bank? Well, again, what's the purpose of the bank? Well, the purpose of the bank is as a financial intermediary. It has a place where you can put your savings, all right, and then your savings are there for you to use at a future date. All right, you can end up having two different types of accounts. You can have a savings account and then also a checking account. The savings account would end up holding your money, and when you needed to spend it, you would move it over to your checking account and then again use a check or your debit card, all right, in order to pay for things like at the store, or again, if you have a bill to mail through the mail, or if you have electronic banking, which is very common these days, you can use it with the checking account to pay your bills. Now again, there are a number of types of banks. There are commercial banks, all right? Well, again, those commercial banks are larger, all right? They deal with larger businesses, although some will deal with customers, right? You have savings and loans. You have credit unions, and you also have savings banks. All of these provide basic needs for the individuals who will go there, all right? Financial information, all right? Your savings account, your checking account, all right? Your ability to borrow money. So again, all of these institutions are financial intermediaries, and they all act in a similar method, all right? Again, when you're looking at rates of return, remember, interest that we earn on our savings account is the cost of money, all right? You give the money to the bank, and they have to pay for it, and they pay for it with that interest rate, all right? There are also a loan. Now, a loan, typically will charge an interest rate greater than the savings rate. The spread between them is how the bank makes their money. So what happens is you put the money in the bank, you end up getting some type of a savings rate, all right, something that you're going to tell me later on, all right, and you're also, if you go to the bank to take a loan out, say for a car, you might pay a higher rate of interest. So say it's 5% for the loan, 1% for the savings, the bank earns that 4% spread. All right, there are other types when you're looking at it. The interest rates on your checking accounts. Many checking accounts don't have interest rates, all right? Some do, all right? They're normally for larger denominations, people who are holding more money in those checking accounts who will also get some type of an interest rate. Your savings and your money market accounts, all right? Those are common to us. We save in a savings account. As you get a little bit more sophisticated, you may use money market accounts. They give you a little bit more interest, right? But again, there's other demands on that. Sometimes you're not allowed to take that money out in a form like a CD, a certificate of deposit. You have to leave your money in the account for 6 months, 9 months, a year, 2 years. You'll get a higher rate of interest, but there are penalties if you take the money out early. So what happens is you need to make sure that if you're putting your money into a CD, all right, you need to make sure that you're not going to have to access that money over that period of time because the fees will be greater than any amount of interest you would have earned to date on that savings for the CD. All right. There's also treasury bills. Now, treasury bills are 90-day paper issued by the federal government. All right, again, it's there for them to pay their short-term bills. Now, again, a treasury bill is sold at a discount. It's called a discount security, meaning that you'll pay less than the face value, and then on maturity date, you'll get a face value of what that value is. So say you ended up purchasing a $10,000 treasury bill. You only pay $9,942.50 for it. All right, 90 days later, you end up getting the $10,000. All right, the amount you pay on that given day and the face value, the difference between the two, the calculation will be made to figure out what the interest rate will be on that treasury bill. Now, another type of savings that you're pretty common with, or you probably are familiar with, is a savings bond. You know, when you were a little kid, maybe when you were first born, your parents received gifts. People bought savings bonds figuring, you know what, when the kid gets old enough, they'll be able to use that money for, say, college, all right, or to buy that first car. All right, savings bonds are also, they're deep discounted. All right, and it usually takes about, today, 16 years till maturity. But again, you'll pay $25 and 16 years later, you'll have $50. Or $50 and 16 years later, you'll have $100. All right, so again, there's a rate of interest on all of those types of returns. Right? Now again, because of the low interest rates that we've experienced over the past decade, right, a lot of people don't like to save, right, which becomes a problem because of the fact that if there isn't savings, all right, what happens is that more people will spend, all right, their money today, not saving for a future date. And again, the amount of loans that are given out will deteriorate because of the fact that the banks will not have that savings to support their loans. So again, when you're looking at investments, all right, which will come in a later chapter, but you're looking for a greater rate of return than you can get at the bank. All right, and again, that's of interest to some individuals as they go through. All right. Now, when we move to the bank, we see the services they offer. Now, most of you probably have a bank account. You've had one for years. Probably you started when you were a little child, all right, 5, 6, 7 years old. You found some money. You got a birthday gift or something, and your parents said, well, you know what, you can spend some of it, but let's put the rest of it in the bank. So again, we end up putting money in the bank. So what's in the bank and what do they offer us? Well, obviously, the easiest one is the savings account. All right, they have a savings and they have checking accounts. Some banks will give credit cards. All right, credit unions are great for first-time credit card recipients because what happens is if you're a depositor in a credit union, you're deemed to be a shareholder, and they want to keep you as their client. So many of them will offer credit cards to individuals when they're getting to go away to college. Normally, you're going to need a co-signature on that, probably one of your parents. All right, so what happens is you can end up getting a credit card at a very early age while you're in high school or while you're in college. But again, with credit cards, there's a lot of responsibility, which we'll cover again in a later chapter. Right? Banks also give loans for cars, school, or mortgages as they go through. Banks have insurance policies that they can give out. Many banks offer mutual funds, which is a type of investment that's highly diversified, again, relatively safe, depending on which type of a mutual fund that you purchase. But again, they're out there for you, and the bank wants to put your money into some type of investment. You'll get a greater return than your bank account. They also offer some financial services. You can go in and get financial planning. If you don't know how to make a budget, which you should now because we covered that in the last chapter, all right, but you also, all right, might need some information on doing other things. All right, the bank has financial planners there. All right, they have securities brokerage. So again, if you wanted to buy stock or those mutual funds that I previously mentioned, all right, you could get them at the banks. All right, they help with your taxes, maybe filing them and planning on how and when to pay your taxes and so forth. All right, remember, a lot of people are very happy when they get a tax return, but the tax return is April in many cases, or even afterwards. And you have paid that money to the federal government and to the state beginning in January of the previous year. They do not pay interest on that money. So what happens is you're actually financing the federal government or your state with that tax money and not earning any interest. So again, you want to make sure when you're filling out information to start your job that you pay the least amount of taxes as possible. All right. Again, it's all legal. All right, so again, we're not trying to skim out the government. We just want to make sure that we pay the right amount as we go through. Later on in life, you might acquire a lot of wealth and you want an estate plan. What am I going to leave to my heirs? All right, and also other individuals, maybe charities and so forth. So again, you can set up estate planning. Trust for your children. All right, if you end up having a lot of money and you have children at a young age, you want to put money aside for them. All right, but you don't want them to touch it until they become more mature. You can set up a trust. And then lastly, planning for your own retirement. All right, what does that take into consideration? Well, remember, as we talked about previously, you're going to be working for 50 years. All right, so start saving as early as possible, because of the fact is you do not want to wait, because if you do wait, you're going to pay extra into those retirement accounts than you would if you started at an early age. So again, let's just repeat some of the things that they offer. The first one, checking and savings accounts, to go into more detail. Well, again, a demand deposit is what we're all familiar with. We put our money in the bank, we walk to the bank, or we go to an ATM machine, we put in our card, or we fill out a slip of paper, and we put it in front of a teller, or we take it from the ATM, and we get our money right at that point. That's called a demand deposit account. All right, we're putting the money in, and we can take it out whenever we want. Now again, the banks understand that everyone's not going to take all their money out at the same time. So again, lending money is going to be profitable for them. So again, they're not going to run out of money at any point in time. Another type is a time deposit, which I mentioned earlier, like a certificate of deposit or a CD. Right? You put your money away for a period of time that you can't touch. All right? So again, those are some of the types of accounts. All right? There's also, when I mentioned earlier about checking accounts, that give you interest. All right? Sometimes they're called now accounts. All right? So again, those are beneficial to you if you need to put more money in your checking account for business purposes, or even if you're a wealthy individual who likes to keep more money in your checking account. And again, you get some type of interest on it. Probably not the same amount as a savings account, because they realize that if you have a savings and a checking account, that you're going to be taking the money out of the checking account more often. So again, they're going to charge or give you a lower rate of interest on that. All right. I mentioned money market deposit accounts. All right. These are things that are going to give you higher interest rates. All right. But again, they're invested in things that might be a little bit more time consuming, and again, a little bit more risk involved in it as you go through. So again, they might not always make money. They possibly could lose some money for you as you go through. All right. The banks nowadays, which your generation is very familiar with, is electronic banking. All right. So again, we all have a bank card. We have our debit card. But remember, that debit card is attached to our checking account. All right. And it could also be when you access your savings account. So you need to be very careful with that, because again, that savings or that card is the same thing as having cash in your pocket. If you lose your wallet, all right, someone will have access to that. If they have your PIN number, they could go to the bank and they could take every bit of money that you have in your account out. So again, if you have a wallet and you keep your debit card in there, do not keep the password in there also. You want to protect your passwords at all costs and put them aside as you go through. All right. Another thing you want to have is your automated services. All right. Your ATM machines are great. All right. Especially if you're not a people person. You don't have to go up to the counter and deal with a teller. All right. You can go in, put the card in the ATM, and get money at any time during the day. Just remember, if fees are charged because you're not using an ATM for your bank, be careful when you're taking money out. All right. Remember, if you only take $10 out or $20 out, and usually in $20 increments, if you take $20 out, they're going to charge you a fee if it's not your bank of 3%, or of $3, and that ends up being 15% on that withdrawal. So again, if you find yourself in a situation where you need to take money out because of the fact that you're going to be spending it at that moment, all right, you might want to take more money out. So again, your fees aren't as high percentage-wise as you go through. All right? And always remember, protect your passwords in all cases. Passwords for your computer, passwords to your bank accounts if you're banking online, and passwords to your ATM cards, all right, and your debit card, because of the fact that people who are near and dear to you are more than likely the ones who are going to end up getting those passwords. All right, people ask questions, new roommates. Oh, what was your mother's maiden name? Well, that's one of the things that banks ask you when they're looking at securing your account. So again, everything like that, you keep on the hush hush. All right, don't make your passwords so common, like your birthday. All right, and things along those lines. All right, so again, just keep that in mind as you're going through. All right, so again, when you're looking at the bank, all right, the type of cards you're going to get are the ones that we're familiar with. You get a check card or a debit card. All right, another one would be value cards as you go through. All right, you could get them with a preset limit. So again, you can't overspend. Sometimes people have problems with that. So again, this might be something that you might want to look into. All right, they also have credit cards at the bank. All right, and again, if the bank offers a credit card, remember, credit card's not cash. Credit card is a loan. All right, so again, you're borrowing the money for a period of time. So again, you need to repay that as you go through. All right, other electronic services. When you start work, all right, direct deposit. You get your money quicker. All right, it's in the bank, and no risk of losing that check after you get it, and no delay. Sometimes you'll get a check on a Friday afternoon. The bank's closed. You don't do anything. You sleep in on Saturday. You miss the bank again. Now all of a sudden it's Monday. All right, where you could go to that bank and maybe you forget about it. So now all of a sudden now the check isn't in the bank for 3, 4, 5, 6, 7 days. You're losing some interest on that. Right now, 1% interest or less. All right, it's not normally a big deal. But again, at some point in time in your life, it will be. All right, electronic transfers. You can move your money online between your savings to the checking when you need it. All right, which is a good thing, so you don't bounce checks and so forth. All right, you can transfer money to third parties. All right, so again, that's a benefit. You don't have to take the money out, find your friend and give them the money. You can transfer it right to their account. All right, nice and quick and easy. All right, you can do online banking. All right, you can pay bills by phone. All right, although that's a little antiquated if you can do it online. All right, and you also have the ATM machines. So again, the ATM machines came into play back in the late 70s. All right, early 1980s. They became pretty much everywhere. And what happened is less time spent at the bank. All right, less time dealing with tellers. All right, and again, it also adds its headaches. All right. People get your ATM card, all right, and then they can rob your accounts without you really even knowing it. All right, again, back in 1978, a law went into place to protect, all right, the rights of individuals who use electronic transfer systems and so forth. So again, just keep that in mind that there is protection out there. All right. Next, we're going to move into the type of accounts that we use. The first one's your checking account. All right, probably all of you have a checking account. All right, so one of the most important things that you're going to get from the checking account is your bank statement. All right, that bank statement should be kept every time you get one at the end of the month. All right, if you're getting paper copies. If you're not getting paper copies, then you'll be checking it online. You should always make sure you register every check that you write. All right, keep a log. The bank gives you a little bank book, so again, you can write in, today's check is going to church, and it's going to be for $10. So again, you write that into your book. All right. A couple of days later, the church cashes your check, and you see it goes through the bank. Check, it's paid. And again, you want to know all the checks that I've written, all the checks that have cleared, all right, and which checks are still open, because of the fact that if you look at your account and it says, I have $100 in my account, but you wrote a check, all right, for $92, and that has not cleared yet. You only have $8 in that bank, so you can't write another check for more than that $8, or otherwise you're going to bounce a check. If you bounce the check, all right, you're going to get charged fees, all right, and possible fines, all right. And again, you might end up having to pay fines to your bank or to the person you write the check to. In my town, the dry cleaner has right there above the counter any return check is going to be $25 charge to you, and then all your bank charges that you have. So again, it could be costly if you're using a check and there's an overdraft on it. All right. So again, another thing that you're going to be able to get when you get that statement, you want to reconcile those accounts to make sure you know exactly how much money is in there as you go through. All right. Another thing you want to look at is, what do the banks have to offer? All right. You live in a town, maybe there's more than one bank. See which one gives you the best rates when you're opening up the account. You can look at the services they provide for you, all right, the location of the bank, but more importantly, the location of their ATM machines. All right, now that you're in school, you want to make sure that there's an ATM on campus or close by, which is associated with your bank where you have your money. Otherwise, you're going to be paying extra fees. My suggestion would be, if you have a local bank to your school, take some money from your bank close to home, put it in the bank close to school. All right, so again, that can be your transactional bank. All right, and the one at home can stay there. If you need money, all right, you can always transfer from one bank to the other bank. All right, and again, that way you're going to avoid all those fees as you go through. All right. Also, if you're going to need to go into the bank, you might want to look at what the bank's hours are. Now, generally speaking, the ATMs are open all the time. All right, unless they're refilling them. It's always frustrating when you show up and you think you're going to get some money out, and all of a sudden the ATM is closed for a time being because they're restocking all the money. All right. If that's the case, you may have to wait. All right. Hopefully the ATM is not broken, or else you have to come back or find another ATM which supports your bank and your system as you go through. All right. The cost of the checking account. All right. Are there ATM fees? All right. Are there costs for checks when you need new checks? All right. All of these you can find out from the bank before you open your account. So again, you can compare, all right, and shop the banks, all right, to find out which one's going to do best by you, which is always what you want to do. You want to make sure you're being serviced the best as possible, all right? So now, how to write a check. Now again, it seems pretty simple, but you have to really look at the check. All right, if you're on slide 19, you can see that check, and you can see up in the left-hand corner, there's a name, an address, all right, which pretty much gives a lot of information to people. It gives the bank name also on the check. But down on the bottom, you see a bunch of numbers underneath the memo. All right, that's the wiring to your bank, and then it has your bank account. All right, so again, when you're looking at this, it has your bank account, and then it has the check number at the end. So right now, look at what happens. You have an individual who finds one of your checks not written, right, in the garbage that wasn't properly disposed of, and they end up having your name, your address, your bank, all right, and your account number, all right. There are very devious people out there, and guess what? They can use all that information to get information and get your money. So be careful with that. Again, you fill out that check, and you can see, put your date in, right? You put who you're writing the check to, the amount, write out the dollar amount, all right, and go from end to end. All right, if it doesn't fill up the whole word, draw a line all the way to that D in dollars so no one can add anything to your check. Like if you put $10, make sure you don't put $10 all the way to the right, because someone could put in front of it $110. And guess what? They just have to change that number up top, put another one in there, and you're out $100 because someone, finagled your check a little bit. All right. Now, again, when you get your check, say from business, all right, so you get your paycheck, make sure you only endorse the check when you're at the bank. If you endorse that check, put it in your pocket, all right, put it in your wallet, and that check falls out, whoever gets that check can cash it. So again, make sure you wait for the endorsement. If you're going to deposit the check under your name, under your signature, you write for deposit only. All right. And again, in that case, it will only go into the bank. The bank will not give cash to that person who's going to, deposit that check. It's all going, or cash that check. So it's all going into your account. All right. You can also endorse to a third party. So you're not going to get any of that check. You can endorse all your checks today, if you have any, to me. All right. And then I can cash all those checks. All right. It's just a joke, so I don't end up having any criminal activity pinned against me here. All right. So again, when you're maintaining your checking account, you want to make sure you have that register, you have your bank statement, all right, and what you do is you reconcile your bank account or your checking account. Every check you wrote, you check to see if it cleared, all right, and it cleared for the right dollar amount, and you can check them all off. So again, you make sure that 1, all your checks are logged in, 2, only the checks that you logged in were actually cashed, all right, for the proper dollar amount. And in that way, you'll know exactly how much should be left in the account. You'll know, oh, look, the 2 checks I wrote near the end of the month haven't cleared yet. those checks add up to be $125. So therefore, even though the balance says I have $200 in my checking account, I don't. I only have $75. And again, in this case, knowing the exact amount you have in your account will protect you from any overdrafts, meaning you don't want to bounce a check. All right? So again, if you look at the register, you just log the checks in. It's simple accounting. All right? Now again, if you're not an accounting major, all right, it might be advanced accounting for you. But again, when you look in, you just write the person's name, write the checking account, the check number, the date, that person's name, how much money, and then again, when it gets deposited, you check it off, all right, and make sure it's for that right amount of money as you go through. You get that bank statement at the end, and these are all the tools you need, all right, to make sure that you end up having your account balanced, all right. There's no bouncing of checks, all right, and then everything in your checking account is exactly as it should be, the way you made the checks out, and again, all the people got paid properly. And again, you have a record. If someone comes back and say, you know, Mr. Finnegan, you never paid us. Well, I have a record of a check being cleared with your endorsement on the back. So again, I have a record that I did pay you, all right, and it will protect you going forward, all right. The next type of an account that we're familiar with is a savings account. All right, the purpose of the savings account is to put money in that we've earned, but we're not going to spend it right now. All right, we don't need to spend everything when we earn our money. So again, we end up putting money in the account. Well, why do we save? Well, we save for future purchases. We save for future investments. All right, you might be saving money because guess what? The holiday season's coming. So I want to buy nice Christmas gifts for people, so I'm going to start to save now. Or you might say, you know what, mom and dad gave me the old car, right? That old car is only going to last for another 1.5 or 2 years, and I want to buy a new car. So again, you start to put money aside for that future investment. So again, in order to make sure you don't spend money that you're saving for something else, you can open up multiple savings accounts, right? Don't be hesitant to do that. The bank will do it. They'll end up having your account, you know, savings account number 1 could be for all your, you know, activities that you're just saving for at a future date, all right? You might have a Christmas club account, all right, or for the holidays, all right? And then you also could have for future investments, your car and so forth, all right? But also remember, emergencies pop up, all right? When you own a home, say, all right, the hot water heater breaks. Well, again, it's tough to take nice warm showers without a hot water heater, or to do your laundry, or to wash dishes. So again, you need to replace that. And again, emergencies are just that. You don't know when they're going to occur. So again, you want to make sure you have a rainy day fund also. So again, regular savings, all right, holiday savings, all right, future purchases, major future purchases savings, right, and then emergencies. So again, you can have as many of those savings accounts as you wish, all right? Again, many people get worried, ooh, is that too many? No, it's fine. You can have as many as you wish, all right? Again, when you're looking at what happens to your money, all right, the banks give you interest rate, all right? And interest rates compound, meaning that when you put money in, it earns interest, and then it earns interest on top of the interest. So what happens is, as you put the money in, it's going to grow at a faster rate. So if you put $100 in, all right, in a year you earn 3% interest on it. Now you have $103, all right? And then next year, it earns another 3%. Well, again, you don't have $106, you have $106.09, all right? So again, it's compounded at a faster rate, so money is growing. So again, if you look at the chart on slide 27, you can see different interest rates, how quickly things compound. All right. Now again, right after that one, there's a little example, and it talks about a 20-year-old student right around your age, all right, who decides that they want to save $3 every day. They save that money up, and at the end of the year, they deposit it into an account that's going to give them a 7% return. All right. Now again, when you're looking at this, all right, a 12% return. Now, many people go, well, Professor, how are you going to get a 12% return? Well, again, if we go back to the 1920s, all right, since the 1920s all the way up until today, the S&P 500 has given us a 12% return. So again, you could put your money into a mutual fund, all right, or some type of an ETF, all right, which is an exchange traded fund with lower fees, all right, which will earn you a 12% average over a period of time. So again, that's not an unrealistic goal for this person. So they just decide to save the $3 a day, which comes out to be $1,095 a year, puts it into the account for 12%, all right? And then again, if she's saving until she's 65 years old, how much money will she have? Well, again, you put it in the calculations, all right? Use a financial calculator, accumulate the money, put in the compounding and how often it compounds, and you can see that that person will have almost $1.5 million by the time they're 65. So over those 45 years of savings, all right, that person at $3 a day ended up with almost $1.5 million, all right? If they decide to retire at that time, will they be comfortable? Well, we don't have a crystal ball, so we don't know what life is going to be like 45 years down the road, but they'll be better off than people who wait. So again, when you start working, or even today, start saving as early as possible. All right, if you're not missing the money, you can put it away. I'm not saying to put your entire savings or your entire paycheck into a retirement account, but again, you can put a small portion and not even miss it as you go through. All right, now, say you were someone who waited until they were 40 before they started to, plan for retirement. And many people do this. When in their 20s and so forth, they have other obligations. They might even have kids. All right? And what happens is they start to save and spend all their money on a new house. All right? They end up saving their money buying new cars or planning for their kids' college education. So they put this money into those accounts, all right? And then all of a sudden they get to be 40, the kids are starting college, they've saved enough money, and then they start to look, well, what are we going to do about our retirement? All right? And then they look, time is whittling away. They only have 25 years left. So again, at that point in time, all right, if they were to put $3 a day into the same account that that 20-year-old started, right, when by the time they got to 65, they would only have $146,000. So again, the difference between $1.5 million and $146,000 is pretty large, all right? And this is all based on the fact that one person waited and one person didn't. So what happens is, just to catch up, that person is going to have to put about $10,000 a year in savings to get to that $1.5 million upon retirement. All right, and again, if that's their goal, that $1.5 million, they have a lot of savings to do at this point in time. All right, so again, just like with your checking account, you can also look at shopping around to get savings accounts. All right, so again, you look at the different types of banks. All right, is it a prominent name in banking? All right, do they give higher interest rates? All right, all those things taken into consideration. Its location, all right, the amount that you have to keep in your account at times, what interest rates you're going to earn, all right, what the return